Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial markets. Sri Lanka's workers' remittances have climbed to a record high in May while also lifting cumulative inflows for the first 5 months of 2026 to an all-time high. According to the Central Bank of Sri Lanka, inflows rose by 36.2% year-on-year to $847 million in May. This marked the 5th consecutive month of strong growth and one of the highest monthly performances on record. The May inflows were the second highest ever recorded, behind the $879 million reported in December 2025. They also exceeded the $641.7 million recorded in May 2025, highlighting continued upward momentum. On a month-on-month basis, remittances increased from $767.9 million in April. During the January to May period, total remittances rose to more than $3.9 billion. This represented a 26% increase compared with the same period a year earlier and marked the strongest first 5-month performance on record. According to the Central Bank of Sri Lanka, remittances continue to play a key role as the country's largest source of foreign exchange. They are providing critical support to external reserves and broader macroeconomic stability, particularly amid pressures on export earnings and tourism. The strong performance follows a record full-year inflow of $8.07 billion in 2025. That figure was up 23% from the previous year and marked the highest annual remittance inflow ever recorded. Central Bank of Sri Lanka data also show a sharp recovery in inflows since the 2022 economic crisis, when remittances fell significantly due to foreign exchange shortages and a rise in informal transfer channels. Inflow rebounded strongly in 2023, followed by continued growth in 2024 and 2025, supported by increased overseas employment and higher average transfers per worker. According to the report, workers' remittances have historically remained one of the Sri Lanka's most stable external revenue sources, averaging around $7 billion annually between 2014 and 2018. According to Sri Lanka Customs, revenue from the vehicle sector continues to contribute around 1/3 of total customs collections. Sri Lanka Customs spokesperson, Additional Director General Chandanapunchi Heva, said the expected slowdown in vehicle imports has not materialized, even though there were reports of unsold vehicle inventories in the market. Customs data show that vehicle-related taxes contributed 91 billion rupees out of 235 billion rupees in January. In February, the sector contributed 75 billion rupees out of 215 billion rupees. In March, it contributed 77 billion rupees out of 231.9 billion rupees. In April, the figure stood at 84 billion rupees out of 242.9 billion rupees. As at 28 May, total customs revenue stood at 212 billion rupees, with 76 billion rupees generated from vehicle imports. Sri Lanka Customs noted that vehicle imports continue to account for around 30% of total customs revenue, broadly in line with last year's range of 30 to 35%. According to officials, import volumes have seen a slight decline following the surcharge, but this has not resulted in lower revenue collections. Sri Lanka Customs also stated that the depreciation of the rupee against the US dollar has supported revenue growth as it increases the rupee value of import duties and taxes. The government imposed a 50% surcharge on customs import duty for vehicle imports in May as part of measures to manage foreign exchange outflows and control import demand. The Central Bank of Sri Lanka has introduced new regulations governing the conversion of export proceeds as part of efforts to strengthen foreign exchange market stability and improve liquidity within the banking system. The amendments were issued through the repatriation of export proceeds into the Sri Lanka Rules No. 2 of 2026, signed by CBSL Governor Dr. Nandalal Veerasinghe. Under the revised framework, exporters who receive foreign currency earnings during a calendar month are required to convert any remaining balances into Sri Lankan rupee by the 10th day of the following month, after meeting approved foreign currency obligations. According to the regulations, exporters may continue to use export proceeds for a range of authorized purposes before conversion. These include payments related to export operations, servicing foreign currency loans and approved borrowings, dividend payments to non-resident investors, salaries of expatriate employees, business travel requirements, and certain approved investments. The rules are also applied to indirect exporters who receive foreign currency payments from direct exporters. They too are required to convert any remaining balances into rupees after meeting authorized foreign currency commitments. The amendment comes amid volatility in the foreign exchange market, where stronger demand for US dollars and tighter liquidity conditions have placed pressure on the exchange rate. According to market participants, importer demand for foreign exchange has increased, while some exporters have delayed currency conversions in anticipation of exchange rate movements. The central bank expects the revised rules to increase the flow of export proceeds into the domestic foreign exchange market and enhance the availability of foreign exchange liquidity within the banking sector. According to the report, Sri Lanka had previously tightened export proceeds conversion requirements during the economic crisis before gradually relaxing them as external sector conditions improved. The latest amendment requires exporters to convert residual foreign currency balances on a monthly basis after meeting authorized obligations. The move follows recent engagement between the central bank and market participants aimed at supporting orderly conditions in the foreign exchange market. Borrowing costs for businesses are showing signs of increasing following the recent monetary policy tightening by the Central Bank of Sri Lanka. According to central bank data, the average weighted prime lending rate or AWPLR rose to 10% in the week ended 5th June 2026. The rate increased by 10 basis points from the previous week and returned to double-digit territory for the first time in more than 2 years. The AWPLR is the benchmark lending rate offered by banks to their most creditworthy corporate customers and is considered a key indicator of borrowing costs for businesses. The increase follows the Central Bank of Sri Lanka's decision to raise the overnight policy rate by 1 percentage point to 8.75% from 7.75%. According to the central bank, the policy move was aimed at addressing inflationary pressures linked to higher global oil prices and heightened geopolitical tensions in the Middle East. The regulator also sought to ease pressure on the rupee, moderate rapid credit growth, and support overall macroeconomic stability. Market interest rates have already begun responding to the policy adjustment. The average weighted call money rate increased to 9.16%, while Treasury-bill yields also moved higher. The benchmark 364-day Treasury-bill yield rose to 10.02%, reflecting broader upward pressure on market rates. The developments come amid continued strength in lending activity. Private sector credit expanded by 100.5 billion rupees in April, recording a year-on-year growth of 27%. At the same time, broad money supply, measured by M2B, expanded by 11.6% on an annual basis. Meanwhile, the rupee had depreciated by 7.8% against the US dollar as of June 5th. According to the latest indicators, the rise in market interest rates reflects the early transmissions of the central bank's policy tightening measures, with businesses likely to face high borrowing costs in the period ahead. Let's take a look at this week's Treasury-bill auction results. With the recent Treasury-bill auction, the 91-day T-bill rate stands at 10.09%, up by 25 basis points. The 182-day T-bill rate stands at 10.27%, up by 26 basis points, and the 1-year T-bill rate stands at 10.16%, up by 14 basis points compared to the previous week. Thank you for watching. We'll be back next week.